Some weeks ago, the Australian Bureau of Statistics released updated consumer price index figures that most media outlets barely covered. The data showed something unexpected. For the first time in modern memory, Sydney's housing-to-income ratio now exceeds that of New York City when adjusted for purchasing power parity. Melbourne isn't far behind. This isn't about a housing bubble. It's about a fundamental shift in how two allied nations have managed their economies over the past 15 years. And the consequences are just beginning to surface. If you're over 55, this matters to you directly. Your superannuation is denominated in Australian dollars. Your property wealth is tied to local market stability. And if you have children or grandchildren, their ability to build wealth in this country is being determined right now. The comparison with America isn't academic. These are the world's two most successful Western democracies. They share language, legal systems, and strategic alignment. Yet their cost structures are diverging rapidly. That divergence tells us something important about policy choices, resource management, and what Australia's next decade may look like. In this video, we'll examine three things. First, how we arrived at this point. The decisions made between 2010 and 2020 that created today's reality. Second, what the 2026 data actually reveals when you strip away the headlines and look at the purchasing power of ordinary households. And finally, what this means strategically for Australia as it tries to maintain living standards in an increasingly competitive global economy. Let's begin. To understand today's situation, we need to briefly go back to 2008. The global financial crisis hit both countries hard, but their responses were fundamentally different. Australia avoided a technical recession through aggressive fiscal stimulus and continued commodity exports to China. The mining boom was in full swing. Canberra had room to spend, and it did. America, by contrast, entered a brutal deleveraging cycle. Housing collapsed. Banks failed. Unemployment spiked above 10%. For the next 5 years, the US restructured its economy. Painful adjustments were made. Manufacturing declined further, but productivity in tech and services accelerated. Australia, meanwhile, rode the resources wave and delayed structural reforms. Here's what most people missed at the time. Between 2010 and 2015, Australian household debt-to-income ratios climbed to among the highest in the developed world. Property became the dominant store of wealth. Superannuation flowed heavily into real estate investment trusts. The assumption was simple. China's growth would continue indefinitely, commodities would stay elevated, and immigration would keep inflating asset values. Two of those three assumptions have now weakened. By 2020, Australia's economy was structurally different from America's. More concentrated, more dependent on a single trade partner, and far more leveraged to property. Then came the pandemic. Both nations printed money. Both ran massive deficits. But inflation arrived differently. In America, it peaked at 9% and fell rapidly as the Federal Reserve tightened aggressively. In Australia, inflation proved stickier. Why? Because so much of the cost base is non-tradable. Electricity, labor, housing. Which brings us to 2026. Let me show you what the data actually says. I want you to look closely at this comparison. Not the headline figures, but what they mean for household formation. In Sydney, the median house price is now 13.2 times median household income. In Melbourne, it's 11.8 times. In New York City, it's 8.4 times. In Los Angeles, 9.1 times. When you adjust for purchasing power parity, the gap widens further. An American household earning $75,000 has significantly more discretionary income after housing and essentials than an Australian household earning the equivalent in local currency. Here's why that matters. Australia's economy has become what economists call low dynamism. New business formation is sluggish. Productivity growth has stalled. Young professionals increasingly work for government, large corporations, or foreign multinationals. The cost structure discourages risk-taking. In America, By contrast, the venture capital ecosystem still functions. Tech talent can afford to join startups because housing in Austin, Denver, or Raleigh remains accessible. Failure is tolerated. Capital flows to new ideas. Now let's talk about essentials beyond housing. Electricity costs in Australia are among the highest in the developed world. Not because of a lack of resources, we export massive quantities of coal and gas, but because of policy fragmentation and underinvestment in grid infrastructure. The average Australian household pays roughly 40% more for electricity than a comparable American household. Food costs tell a similar story. Despite being a major agricultural exporter, grocery prices in Australian cities now rival or exceed those in major US metropolitan areas. Supermarket concentration is one factor, but transportation costs and regulatory burden play a larger role than most realize. What's unusual here is how little this shows up in official inflation measures. The Reserve Bank of Australia tracks a consumer price index that smooths out these impacts. It includes items most older Australians no longer purchase frequently. It underweights the things that dominate household budgets: shelter, energy, healthcare. When you recalculate inflation using a fixed basket weighted toward retirees, the real increase over the past 5 years is considerably higher than the official figure. This is the part most headlines miss. Let me give you a concrete example. A retired couple in Brisbane living on a defined contribution superannuation fund saw their nominal balance grow modestly over the past 3 years. But their real purchasing power, what that money can actually buy in goods and services, has declined by approximately 11% since 2021. In America, a similar couple benefited from higher interest rates on savings and lower effective inflation on non-housing essentials. The divergence compounds over time. Now, to be fair, Australia still has advantages. Universal healthcare through Medicare remains more efficient than the American system. Pharmaceutical costs are lower. Public education is well funded. But these are legacy systems, built during a period of greater fiscal capacity. The question is whether they can be sustained as the workforce ages and the tax base narrows. Let's think through the second and third order effects of this divergence. If living costs remain elevated and wages grow slowly, what happens to Australia's human capital? We are already seeing the beginning of a brain drain. Engineers, data scientists, medical specialists, they can earn 30 to 50% more in the United States after adjusting for cost of living. The ATO reports that skilled emigration has accelerated since 2023. Not dramatically, but enough to create gaps in critical industries. If that trend continues for another 5 years, Australia loses the exact people it needs to diversify away from resources dependency. Here's the strategic bind. Australia's alliance with the United States is its primary security guarantee. AUKUS, intelligence sharing, force posture, all of this relies on maintaining close alignment with Washington. But economically, Australia is drifting into a different orbit. China remains the largest trading partner by a significant margin. Efforts to diversify have been slow. India, Japan, and Southeast Asia are growing markets, but they don't replace the scale of Chinese demand for iron ore and coal. So Australia faces a structural tension. Its security model depends on America. Its economic model depends on access to Asian markets, particularly China. If geopolitical competition intensifies, and most analysts believe it will, Australia will be forced to make increasingly uncomfortable choices. Cost of living amplifies this dilemma. If Australian households feel economically squeezed, political pressure builds for short-term relief. That often means fiscal spending, which adds to inflation. Or it means protectionism, which raises costs further. Neither path strengthens Australia's strategic position. Now consider the capital flow implications. Foreign investment has historically flowed into Australian property and resources. But if returns in the US become more attractive, higher growth, lower regulatory burden, deeper capital markets, that flow could reverse. We saw hints of this in 2025 when several major Australian superannuation funds increased their US equity allocations at the expense of domestic holdings. That's rational from a fiduciary standpoint. But it creates a feedback loop. Less domestic investment means slower productivity growth. Slower productivity growth means weaker wage growth. Weaker wage growth means households fall further behind on cost of living. The cycle reinforces itself. Finally, let's talk about the political dimension. In America, cost of living is a major political issue, but the scale of the economy allows for regional variation. If California becomes unaffordable, businesses and people move to Texas or Florida. Australia doesn't have that release valve. Sydney and Melbourne dominate the economy. If they become structurally unaffordable, there's no equivalent internal migration option. Brisbane and Perth are growing, but they lack the economic diversity to absorb mass relocation. This creates political brittleness. Governments will be judged increasingly on their ability to manage living costs. And the policy tools available are limited. You can't simply mandate lower prices without causing supply distortions. You can't devalue the currency without hurting retirees and savers. So we are likely to see more interventionist policies, rent controls, energy subsidies, wealth taxes, that treat symptoms rather than causes. Those policies may provide short-term relief, but they don't address the underlying productivity challenge. So when you step back, three truths emerge. First, Australia's cost of living crisis is not temporary. It's the result of structural decisions made over 15 years that prioritized asset appreciation over productive investment. Second, the comparison with America reveals that alternative paths were possible. The US restructured painfully after 2008. Australia delayed. We are now paying the price for that delay. Third, this divergence has strategic implications. Australia cannot sustain its current alliance architecture and economic dependencies indefinitely without resolving the tension between them. The next 5 years will determine whether Australia makes the hard adjustments now, reforming planning laws, investing in energy infrastructure, encouraging business formation, or continues managing decline through fiscal transfers and monetary accommodation. Neither path is easy, but one builds future capacity. The other depletes it. Here's the question I'd like you to consider. Does Australia's geographic position and resource endowment give it enough margin for error to delay these reforms further? Or are we closer to a structural breaking point than most assume? Leave your perspective in the comments. Thank you for watching.